How to trade the first Elliott wave gaps like a pro. How to trade the first Elliott waves gaps like a pro. Good morning, good afternoon, good evening, bonjour, bonsoir, mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW 24 traders. For Elliott Wave Trading, our website is www.24elliottwaves.com. The title of this video is how to trade the first Elliott Wave gaps like a pro. All right. In this tutorial, I want to give to traders, effective Elliott Wave trading tips that one can apply when the financial instrument or the price gaps up during the first Elliott wave. All right. For traders that are following us before, we know that the first Elliott wave is what we call the signature of the bulls. So a financial instrument is about to go up, all right? A bullish trend is about to begin, or a bearish trend is about to begin, all right? There will be what we call the first bias. So in an uptrend, we have the first bias. The first buyers are usually the hedge fund, the big institution, the fundamental traders, that are accumulating the financial instrument during the consolidation phase or at the end of the corrective wave. All right. So remember, if we have a trending phase, a correction, and an Elliott wave cycle has ended, if the correction is finished, the fundamental trader, the hedge fund, the big institution, we check the financials at Google Finance. We do what we call the due diligence. And then once they are satisfied, they will start accumulating or buying gradually, the financial instrument, all right? These are the first buyers. The opposite is also true in a downtrend. A financial instrument is about to begin, a bearish trend. A bearish trend is about to start. We have what we call the first sellers, all right? These are, long-term investors or medium-term investors, all right? The hedge fund, the banks, the big institution will start distributing the financial instrument. They start selling gradually the financial instrument while the general public, is still buying the financial instrument. This is what we call distribution. So the distribution will start before, the bearish trend, and accumulation will take place before the bullish trend. You want to understand what is accumulation and distribution and what is taking place, and also the first buyers and the first sellers. So at the beginning of a bearish trend, we have the first sellers. At the beginning of bullish trend, we have the first buyers. It's very important to understand these patterns, how the market functions. So I would like to refer traders back to our webpage that we call, Elliott Wave Guidelines, So I'll put the link in the description, session for you. So you may check it out, how we start counting the Elliott wave. The most difficult wave, to identify is the first Elliott wave. Once one is able to identify the first Elliott wave, the rest become a little bit easier, So check it out, Elliott Wave Guidelines at 24elliottwaves.com. Watch each videos, These are short videos, all right? So we want to talk about the gaps, how we trade the gaps during the first Elliott wave. So remember what is taking place. So I'm going to give, for the purpose of this demonstration, I will use, a bullish trend, So a bullish trend is about to begin, and the first Elliott wave start, and then suddenly we see a gap. The price gap up from A to B. So here on this chart, I assume that for the purpose of this demonstration, the price was consolidating before, all right? So, and then suddenly we see the first Elliott wave, the price went up a bit, and then a gap up from A to B. So the gap is between the pink line and the red line. For this, allow me to draw on this chart, because this is the foundation of the skill that we're going to build, the knowledge that we want to carry with us, okay? So before we start using that, okay, on a live chat, okay? So this is one thing we want to get into traders' mind. So, all right? So it's stick in your mind forever, okay? So gap during the first wave. So price went up a bit, all right, and then gap up, okay? And then we notice, we label it, this is the first area wave, and it's a gap, price gap up during the first area wave. How do we trade it? How do we handle that situation? How do we trade the gaps during the first area waves, all right? You want to know, and you want to understand it, and trade it like a professional trader, all right? So when we see a gap during the first area wave, which is usually happening because what is happening? Because of the accumulation taking, when people are buying gradually, okay, these are big institutions, and what's happening? The whole place is littered with orders to buy, and at one point, big orders will propel the price from A to B. Boom, price gap up. All right, big, huge move. All right, you see here this Friday. The 23rd of October 2015, you can see that the NAX 100 gap up big time here from the red line to, and the second red line here. But I'm not saying that this gap here is the first area wave gap, but I will use it for this demonstration alone. But this is not the first area wave gap here, but the price did gap up. The NAX 100 did gap up from here to here, okay? So during the first area, we see a gap up from here to here. Follow my cursor from the pink line to the red line, okay? So how do we handle it? What you will do, my friend, is this. Follow me carefully. You will use the Fibonacci retracement tool. So if you don't know about Fibonacci retracement, go to www.dayprotraders.com and watch video, check our webpage about Fibonacci retracements, okay? So we draw it from here. I don't want to dwell on it. So we draw the Fibonacci retracement from the starting point of the gap to the ending point of the gap. All right. That's what I want you to do. Okay. So the gap here, you see the gap has started here. It has ended here. You draw the Fibonacci retracement from the starting point to the ending point. And then I want you to highlight, okay, the 50% Fibonacci retracement level and the 61.8% Fibonacci retracement level. All right. Now, we know that we have what we call a continuation gap. We have what we call exhaustion gap. This is opening gap, okay, opening gap, when the a trend is about to begin and we see a gap, price gap up, okay, this is what we call opening gap, okay. So here the price did gap up and then we draw the Fibonacci retracement from the starting point of the gap to the ending point of the gap and we highlight the 50% Fibonacci retracement level and the 61.8% Fibonacci retracement level. You see the two blue lines, the top one here, this is the 50% Fibonacci retracement level, and the second one is the 61.8% Fibonacci retracement level. We know that a gap during the first area wave is likely to be filled. What do I mean by that? That the price will come back into the gap section. So from the pink line to the red line, that's the section of the gap. But because the gap is taking place during the first area wave, there is a high chance that the price will come back in the section of the gap. For that reason, we must highlight the 50% and the 61.8% Fibonacci retracement level. Very often, the best trading setup, I did not say trading signal, the best trading setup will take place on or near, okay, the 50% and the 61.8% Fibonacci retracement level of the gap. That's it. So suppose we were here and we see a consolidation or an area wave cycle is completed and then we see the price going down, we label it first wave, and then we see a gap during the first area wave. We'll highlight the 50% and 61.8% of the section of the gap. And then if the price pull back slowly and gradually, does not mean that it will definitely come here, but we want to know where is the 50% Fibonacci retracement level and where is the 61.8% level. If the price comes into this section and we see a bullish trade setup, very often this is a high probability bullish trade setup to catch the third area wave. Remember what I say all the time about the third Elliott wave. There is no third Elliott wave without a solid fundamental. So do not use the technical alone. Always combine the wave principle, the Elliott wave technical analysis, with the fundamental analysis, Google Finance, and the wave principle. It makes sense? So at this point in time, suppose we were here, so we see the gap, we did exactly that, and the price, what we were expecting, the price did exactly what we were expecting. It pulled back to the 51.8% Fibonacci retracement level. So what we need to do is to draw, we don't want to withdraw a common second line along the price. So price pull back, suppose we on a weekly chart, okay? So you're going to see this, for instance, on a daily chart or weekly chart, all right, or even a higher time frame, and then we will apply what? A top-down trading method or a multiple time frame trading method, okay? I'll put a link about what is a multiple time frame trading method video in the description section. Check it out, okay? Then we will apply a top-down trading method, all right? The top-down trading method allows day traders and swing traders and position traders to navigate through the market. All right, so without assuming anything, because anything is possible. As I showed trader recently, we say when we see a triangle, all right, we say what? Anything is possible. All right, you see Nasdaq 100 has gap up this, okay, Friday. All right, I will explain to you also, I'll clarify why the Nasdaq 100 has gap up, okay, this Friday, okay. The price pull back here. This is a trading setup. We will use a top-down trading method, okay, to trade it. So when we see this, for instance, on the weekly chart, we'll now go to the 4-hour chart looking for the signal, and then we will use the 15-minute time frame for the entry. I'm not saying that this is the only way one can use a top-down trading method, which I explained to trader already. That's why I put the link in the description section, so you may check it out. Or we see this on the hourly or the daily chart. We can, it's a trading setup, it's not a trading signal. We go to the hourly chart, wait for the signal, and then we may use, for instance, 10-minute time frame, or even go down to the 5-minute time frame to enter the trade on the edge without violating the market patterns. The biggest trading mistake is the violation of the market pattern on any time frame. All right, one can use option to trade it. One can use a CFD to trade it. One can use a binary option to trade it. One can use spread betting to trade it. Okay, it's up to you. The most important thing is the risk control, and the bottom line is the 5% money management rules. All right, step by step. Okay, remember anything is possible. So price pull back to this zone. Now we draw our trend line here. We want a price to break a little bit above the trend line on the edge here. And then we apply top-down trading. Sometimes the price may not go up in straight line. So why usually take place? Why is so important to use a top-down trading method here? So suppose the price break in above the trend line here, and then you use a top-down trading method, and then you enter the trade. Sometimes the price, there will be all sorts of blah, blah, blah. The price may go ups and down here for many days before you see it going up. So that's why. Use a top-down trading method, signal fell, come out, okay? And then control the risk, and it's ready again, enter the trade. So the price does not go straight away, sometimes as you really expect it to go straight away up, all right? So this is how we trade, okay, the first Elliott wave gaps. Price gap ups from A to B, we highlight the 50%, 61.8% Fibonacci retracement level, and we in normal condition, because the second Elliott wave will take place by all means, it will take place. So there won't be any third Elliott wave without the second Elliott wave, all right? So as the second Elliott wave standard wave, you know what are the 13 specific Elliott wave pattern. You want to understand the corrective waves, the corrective wave. So you start analyzing the internal waves of the second wave, all right? All right? You want to analyze it. So you see clearly that the second Elliott wave is completed. You don't assume anything. You say, okay, this is a zigzag pattern. This is, okay, all right? A straightforward correction of the end of the second Elliott wave. You check the fundamentals. The fundamentals are solid. The market environment is viable because you want to catch the third Elliott wave, all right? boom, you apply a top-down trading method, you receive the signal, you take it gently. You want to use call option to trade it, so you can control the risk. You want to use binary option, it's up to you. But the most important thing is, okay, to trade it like a pro. It makes sense? You may see this setup on a monthly chart beautifully there, clearly cut for some stock, for some commodity, for some currency pair. And you see the first area wave, price gap up and pull back in the zone of 61.8% Fibonacci retracement level. The challenge for traders in this case is to know when and where the second area wave has ended. By understanding the corrective waves, the internal waves of a corrective wave, one is likely, okay, to pinpoint correctly where and when the second area wave has ended. But the top-down trading method will allow traders to control the risk carefully here. All right? Does it mean that the price cannot go beyond the 61.8? It can. This is why I'm saying to traders, it's not an exact science. The price can go down up to the 78.2% Fibonacci retracement level. But by using a top-down trading method, we are not trading like old-fashioned traders, just buy because the price reaches a level or a zone, but we are using a top-down trading method. It makes sense? All right? It's very, very important. So following our area wave count guidelines, okay, we have recognized that a first area wave is underway, all right? Now the price gap up. Okay, how do we handle it? This is how we handle it. But the second thing that is also very important, we are trading, okay, which I want traders to start getting that into their head. It's very important. We are not the only person in the market. Traders are using all sorts of trading methods. All right. Some traders are contrarian traders. So when everybody wants to buy, these contrarian trader will sell. Okay. All right. All right. There are some traders, that's how they trade. So they see a bullish trade setup, they will take the opposite side. And also we have the hedging activity in the market. Okay. Market participants are hedging their position by selling another financial instrument to protect their bullish positions. All right. So because of all this taking place in the market, all right, my friend, we want to go into the mind of other traders. Okay, this is critical. So this is how I trade it. So now I want to know what other traders may think. So this is the second point I want you to understand. Other traders may not draw their Fibonacci retracement level, okay, for the section of the gap. They will bring it all the way up here to the top. So price gap up from A to B and then went up a little bit, okay, before coming down. So they will draw it instead from the beginning of the first area wave to the top of the first area wave, and they will highlight their 50% and 61.8%, which will not be exactly our 50% and 61.8% because they have selected 2 points, the beginning of the first wave and the end of the first wave, to highlight it, to draw their 50% and 61.8% Fibonacci retracement. Do exactly the same thing and highlight their 50% and their 61.8% level by drawing it from the beginning of the first wave to the end of the first wave. Have it on your chart and just keep eyes on it and watch the reaction of the price at those levels, okay? But the best approach is to highlight, okay, the section of the gap itself. Now remember, the bottom line is the top-down trading method without violating the market pattern. If you like this video, please give us the thumbs up. If you dislike it, please give us the thumbs down. If you love it, share it on Google+, on Twitter, and also on Facebook. If you love our video, feel free to subscribe to our channel. There is a link in the description section where you can subscribe to our channel. We wish you the very best in your trading, and until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about how to trade the first area wave gaps like a pro. Speak to you soon.